In this tutorial, we'll be looking at the book value valuation method. The book value valuation method is a method that calculates the value of your common stock based on the financial statements. This method is historical in nature, in that it simply looks at the financial statements without incorporating any future expectations about the performance of the company. There are two ways in which you can calculate the book value of an equity stake in a company. You can calculate the total value of all shares in a company. Alternatively, you can work out the value of equity on a per share basis. Before we proceed to the calculation of each of these, it would serve us well to bring up the accounting equation. The accounting equation says that assets bought by the company can either be financed by equity or by debt. So if you want to calculate the total value of your equity, you would need to see how much is left over of your assets once the debt providers have been paid. Another way in which to calculate the value of the equity would be as follows. It would be the ordinary share capital. So that's how much the equity providers bought into the company for, plus the net profit. So this is the income earned by the business minus the dividends. If you're calculating the book value per share, then you would take the owner's equity, as we've calculated in method 1, and you divide it by the total number of shares. There is one thing that we need to be mindful of. The book value method is a conservative method, it's a historical method, and doesn't take into account future expectations, as we already said. So from the assets, we need to remove the value of the intangible assets, unless these are intangible assets that can be valued, like copyrights and patents.